Hi, this is Tim Berkwin, the host and co-founder of TraderInterviews.com. This is one of our recent interviews and an example of the types of shows we do each week. While you're listening, have a look at the membership tab at the top of this page to find out more about our site. Hey, thanks for checking us out and enjoy the interview. Hello, everybody, and welcome back to TraderInterviews.com. Thanks very much for joining us for another show this week. As always, and I say at the beginning of every interview, the idea of all these is to give you something to think about in your own trading by listening to another trader talk about their strategies and hopefully give you a way to think about new ways of approaching the markets you may not have considered in the past. Our guest today is David Buffalo. I found him on Twitter. He's got a pretty active account there where he talks about some of the things he's doing in trading. David, thanks very much for joining us on the show today.
Well, thank you for having me. I'm pleased to be able to help people learn a little bit something different about trading, particularly in the swing trading realm.
Excellent. Good. Well, I want to ask you all about those strategies, but I want to start just asking you briefly how you got into this in the first place and how you became a trader.
Well, it's a really long story. I think I've explained to a couple people before. My dad died when I was 20 years old, and unfortunately, when he passed away, my mom was a bookkeeper, basically, and did not understand how to manage her assets. And we weren't wealthy by any stretch of the imagination, but she had assets to manage. And unfortunately, there was a lot of conflict between business partners and my mom. And unfortunately, she ended up kind of on the short end of the stick. And because of that, and also because of '87, when the market literally collapsed, I had to learn how to invest money and to get a better than average or adequate return. And my first journey in stocks was literally when I was in college. That was the end of 1973, beginning of 1974. And people worry about, well, my goodness, the market lost half of its value in this past little crash. Well, basically the same thing happened at the end of 1974 from the beginning of 73 when there was a double top in the Dow. I don't know if anyone remembers that. Probably no one does. But the point is that I have seen, and I think it's given me a little bit of a better perspective on markets. I have seen markets collapse before, and I'm not one of these guys who ever subscribed to it's different this time, because it's never different this time. Many markets continue to do the same crazy things over and over again. But the bottom line was I learned from that experience that I wanted to, number one, make sure that I protected myself from downside risk, and I also tried to learn or understand what the concept of value was. Now, in that period of time between, let's say, 73 and 79, 80, the markets literally went sideways until we finally sort of had a capitulation. And at that point, stocks were in the single-digit PE range, and I began to learn how to buy stocks on the cheap. And I literally tried to buy a dollar's worth of stock for 50 cents. So that's literally what I'd look for. I looked for PE to growth ratios, and then I began to learn a little bit about support and resistance in the stock market. But as time went on, particularly in the late 80s, like I say, there was a conflict of agency with my mom and who was managing money at the time, and they literally kept adding money into the market at the top in '87. And again, I'm a victim of the Greenville County school system. I'll tell you that right now. I'm not necessarily a believer in black swans, even though, like I say, I'm not a PhD and I'm not a smart guy. I don't have a book that's a bestseller list. But the difference in that time and in 73 is you were beginning to see a spike in interest rates as the government continued to want to make the dollar strong, and you also began to see PEs get way out of kilter with the norm, and you knew there was going to be some kind of a sell-off. Well, the folks that were managing my mom's money were continuing to put more and more and more into the market. And obviously on October 19th, 1987, a day I know very well, divide that number by 2, and that's what was left. Mm-hmm. So I learned from that standpoint that you don't want to add to basically a frothy market and literally have everything wiped out. What I learned from that experience is that when you reach a certain profit objective in a stock, even if it's one that you just simply set based on either supply and demand, whether you're looking at support and resistance, or based on a valuation target that you have, once you reach it, you better take some money off the table. Mm-hmm. And I've never forgotten that. That's the biggest thing that I learned from that experience. And then in the 80s and 90s, I began to get involved in technical analysis. Most of what I learned by self-teaching. That is, I would read books. One of the people that I like to read a lot of is, you're familiar with John Murphy, are you not?
Absolutely, yeah.
Yeah, I read most of his books. In fact, the book I read of his was Technical Analysis in the Futures Market, which you say, well, gee, that didn't really have anything to do with stocks. And of course, now he's got one called, I think it's Technical Analysis of the Financial Markets. But the thing that he emphasizes in that book, and I want every trader to learn this, and I don't care whether you agree with me or not, you need to establish price objectives. If you've ever read that book, and I'm sure it's in the new book. Actually, I don't have a current copy of the book. I need to go out and refresh my library on that one because someone stole that book from me.
I think he's got a new edition that he's just come out with as well, or a new. It may not be an edition of the old one, but it's a new book. So he's got something out recently.
But one of the key concepts that he teaches, and I don't care who you are. I'm going to sound like Larry the Cable Guy. The point is, you need to establish price objectives. Once you reach an objective, you need to take a little money off the table. Simple concept, and that's something that he teaches in that book. And what I've always striven for after that time of understanding basic support and resistance was to basically try to figure out a way to measure where any particular security was going from a price objective standpoint, because at least that way I would be able to have a measurable objective and know when to take some money off the table.
So does that mean
that's the key thing?
Are you establishing those levels for yourself in every single trade, the profit target and the stop?
Yes, because I use what basically now are Fibonacci ratios to trade with. In essence, what I'll do is I'll look for basically a 1.27 extension of a previous up move as a primary first target. And then in essence, I'll either look at a 1.414 extension as a second target, and typically a 1.618 extension of a previous up move as a third target. So in essence, I'm always measuring extensions of moves in order to take objective profits as we go up. Now, I also believe in the greatest technical analysis tool known to man. It's called a ruler. I don't know if anyone's ever used one before. They should on a price chart. Mm-hmm. In essence, to identify key supports and key resistances in chart pricing, because that's really the basic fundamental. Well, I can't say that right. Building blocks in any kind of securities analysis from a standpoint of price. Because every price leaves individual clues. They leave. It's almost like leaving trails in a snowbank, which we don't have too many of in South Carolina, but you'll see the one I have on the Twitter page. But the point is, you want to try to establish where those key points are, and then measure everything else from that.
It seems like a lot of traders, they know the retracements. They've heard of Fibonacci retracements. Not enough seem to me to use those extensions. It sounds like that's an important part of your strategy.
It is, and the one difference that I use, and this is something, again, I don't mind mentioning the guy's name, because what I do is not original. And I'll be honest with you, a lot of things that a lot of quote-unquote technical analysts use are not original. It's always been basically an extension or a repeat of something else someone has done before. But I use some of Larry Pesavento's techniques from a standpoint of measuring patterns. Mm-hmm. But the key thing about his patterns are you want to look for a regional high or a regional low. In other words, you want to look for a complete price leg that has been established in previous trading. And from those 2 points, you want to measure retracements and extensions. And that's where the analysis that I use comes from. The only thing that I do differently, and I don't want to put anybody to sleep, but a couple of years, in 2000, I began to see volatility come into the market. And, of course, we had the first correction in this. I still think we're in a bear market regardless. And, again, I'm not a bull or a bear. I'm a buffalo. I tell that to people also. But in essence, what I look for are key patterns.